Geopolitical tensions were rife over the month, and this was particularly the case in European markets, where we saw French President Emmanuel Macron call for snap elections during the month. This was done in an attempt to quell support for Marine Le Pen's National Rally Party. However, contrary to the polls, we actually saw that the new Popular Front won the most seats in Parliament. Elsewhere in Indian markets, we saw that there were jitters there too. So there was uncertainty over whether Narendra Modi would secure a third term. However, in the end, markets did celebrate the fact that he did secure his third term with a stark recovery in Indian stocks during the month, albeit losing over 60 seats in the process. The US Federal Reserve kept the federal funds target rate unchanged at 5.25 to 5%, which was in line with market expectations. However, there were some noteworthy forecast revisions worth mentioning. So we saw the unemployment rate for next year and the following year lift slightly. So this is still in line with expectations of historically low levels of unemployment rate, which is in line with a very strong labor market dynamic. However, we also saw inflation lifted this year and next year in terms of the forecast expectation for personal consumption expenditure inflation on a headline and core level. So because of the high inflation expectation, it was unsurprising that forecasts for the federal funds rate going forward for this year and next year are expected to be a lot more shallower. And because of the need to keep interest rates higher for longer, in line with the recent mantra from the Fed in terms of needing to get inflation back toward 2%, we see that the longer run rate was also lifted from 2.6% to 2.8%. And this is in line with some of the stickiness in inflation that we have seen prevail relative to market expectations so far this year. Many global central banks around the world have actually commenced on the interest rate cutting cycle. So far we've seen the Bank of Canada, the Swiss National Bank, the Eurozone Central Bank, as well as the Riksbank, all commence on the interest rate cutting cycles. Next up is likely the Bank of England, given the fact that inflation has now returned to the 2% target. And in fact, the latest inflation print at 2% registers as the lowest year-on-year increase in inflation since about July 2021. However, core and services inflation does remain quite high, which puts into question how many interest rate cuts can potentially be erected in the coming months. To wrap up, we see that global financial conditions remain relatively loose, and this will be at the forefront of many global central bank decision-making in the coming months. This is because central banks will need to strike a fine balance between potentially reigniting inflation with too many interest rate cuts priced in on the horizon, or delaying potentially some of the interest rate cuts that are needed in terms of keeping a stable growth outcome. So counterbalancing these factors in terms of maintaining a relatively decent growth rate and potentially mitigating against a reigniting of inflation will be central to many global central bank decision making in the coming months.